Good morning, beautiful people. It's your favorite real estate agent, Cierra Thurman, and I'm here to help you build a legacy that moves you. Today, I thought it'd be a good idea to come on here and give you a couple tax tips. Before we know it, it'll be the end of the year. And what does that mean? Tax time is right around the corner. So I thought it'd be a great idea to give you 5 tips for real estate investors. Tip number 1, hire a qualified tax professional on your team. Ideally, this is someone who is a real estate investor themselves or who is familiar with real estate investing. They should be able to help you prepare throughout the year, at least quarterly. Tip number 2 is to get organized. You absolutely, positively do not want to commingle funds. What does that mean? Mixing your personal and your business expenses and money together. You want to keep everything separate. So have your separate business account as well as your separate business credit cards. Tip number 3 is to separate your income activities into separate entities. So for example, you may have a short term and a long term. Your short-term investments will be those that are quick fix and flips, anything that you own less than a year. Once you go over the year, that will be considered long-term. So I would suggest you have at least 2 separate entities, one to handle your short-term investments and another for your long-term. Tip number 4, own rental property. I love, love, love rental property. And after you hear this tip, you will too. So for those that are unfamiliar, rental property is when essentially you're a landlord. Your tenant pays the rent every month. You collect said rent. From your rent, you're going to obviously have to pay the mortgage. There are going to be other expenses that you have to pay as well. And what's left over is your cash flow. The cash flow, that's what goes into the bank. That's your profit. That's your passive income. But something that especially makes rental property pretty good come around tax time is the fact that the IRS allows you to account for depreciation. The IRS says that your property will deteriorate or depreciate over 27.5 years over the time that you own it. So what your tax professional can do for you, they can take a certain percentage of loss from that asset that you're really gaining income from. Tip number 5, earn income like the rich. You may have heard stories about wealthy people earning millions of dollars and not really paying too much in taxes. And you may be wondering to yourself, how is that even possible? Well, it's possible because of the way in which they earn their income, and obviously they have good tax strategies with a great tax professional. One of these tax advantages that you can be taking advantage of is called a 1031 exchange. I'll give you a quick example to explain the concept. Let's say you purchased a property for $100,000. A year later, you sold that property for $200,000. You made a great profit, right? $100,000. Now, some people will be tempted to put that money into their bank account, but you better believe come tax time, Uncle Sam is gonna want his cut. Now, how can you avoid forking over your profits to Uncle Sam? You can use something called a 1031 exchange. Essentially, a 1031 exchange allows you to continue to defer your taxes and roll it into a new asset. Why not roll it into a rental property where then you can depreciate that income, and even though you took a loss, you're really gaining money for that asset. So that pretty much wraps it up for today. 5 quick tax tips for real estate investors. If you like this video, please comment, like, and subscribe. Again, my name is Cierra Thurman. I'm your favorite real estate agent, and I'm here to help you build a legacy that moves you. I'm a licensed agent with Coldwell Banker Realty, Hyde Park. Have a great day.